Hello, everybody, and welcome to the session. Today is March 23, 2023, and this is our SMARTT Tiger Live session. SMARTT, in case you don't know what it means Special Market Analysis Report for Tiger Traders. And it's special because everything we do today is related to options trading. So we look for trade opportunities, we analyze the markets, we use options data to analyze the markets instead of only looking at the charts. So that kind of thing is what we're going to do today. My name is Jose Blasco, I haven't said, and as we are getting started, I would like to highlight on the upper left our financial disclaimer for you to read it carefully. This is important information, like all financial disclaimers, and I'm counting on you guys to read it completely. Also, as we are starting the session, in case you have not been in one of my sessions before, just for you to know, I am watching you. And that means that I am looking at the chat box on YouTube. I am looking at the chat box within the Tiger Brokers mobile app. And therefore, I would certainly welcome. And, let's start now with a quick hello. That would be nice to get a hello from you guys on the chat box. So I'm going to be looking at you guys, as I said, looking at your messages. Your messages may be just comments, which is fine. Your messages may be questions, which is, an opportunity for me to go deeper into what you need. So please interact with me in the format of questions, comments, or anything you'd like as I go through the session. So that way we can make it richer, we can make it count, okay? And again, as we are starting, I would certainly appreciate a quick hello, because that tells me that you're ready to interact. That tells me that you hear me well, sound is good, and that also tells me that the chat box is working fine. So please type anything you like on the chat box, just as a little technical test, and hello is a good way to start. You can see my email address on the screen, jose@tradictive.com. In case you need anything, or you're watching this recorded and you have questions, but you're watching this recorded, so you can certainly contact me. And you can also see all our social media handles, Trade with UFOs, as well as, you can see the Tiger Brokers social media handles in here as well, that you should go ahead and go follow, like, etc., so we can be in touch and you can see what we all do. With all of this said, I think that the session is now, let's call it officially introduced, and it's time for me now to talk about the agenda. So the agenda is very simple. We're going to talk about headlines, what's happening in the market out there. Again, if you are attending this session with me for the first time, you may get surprised at how pragmatic I am. And pragmatic is that, I'm not going to spend too much time with headlines talking about, the history of humankind in the planet Earth within the history of the universe. I'm just going to talk about what is relevant in the marketplace, things that you need to watch, things you need to be aware of, which probably some of them you are already, maybe all of them, but it's important to emphasize what may have an impact in the marketplace. I am assuming you are looking for trading opportunities. Those impacts equal opportunities. I am assuming you may have trades running, you may have a portfolio with positions already running, and those headlines may actually be the source of risk. So we also need to understand that from those two angles. Okay, so we'll talk about it. Then we'll get into identifying market opportunities today, and we'll also do our SMARTT market commentary, so you guys get to understand what's happening in the marketplace, but not only by looking at the charts, but also looking at options data, which reveals a lot of the things that are happening from behind the scenes that we don't see on the candlesticks. Okay, cool. I have a bonus for you guys. Okay, a little trading tool for you that will certainly be useful. You probably know. If you don't, let me tell you that Tiger Brokers is connected with TradingView. So apart from trading with Tiger Broker using the Tiger Broker app, you can also trade with Tiger Broker using TradingView. And this also opens the door to access to additional technologies and additional possibilities on how you do your market analysis and how you find your opportunities. And I will be providing a tool for you guys for free in a moment. My name is Jose Blasco. I'll keep it short. I am a trader. I love to trade. I'm crazy passionate. I trade everything: options, equities, futures, currencies, digital assets. Why? Because everything in life got pros and cons. So while maybe trading futures is great for certain applications, maybe options is much better for other applications, or equities, or currencies, you name it. So I am a diversified trader, and therefore I trade multiple accounts with different purposes. And for all those different purposes, I use different assets as well as different time frames, different methodologies, different tools to make myself efficient and well diversified. If you want to know more about how I trade, of course, as I said a moment ago, you can follow us using the social media handles I showed before. But also, one great way to know more about how I trade is to purchase our book. Our book, it's being sold as low as $3.88. So it's not like it's a very expensive book. You can have it on paperback, you can have it on electronic format as well. And the beauty is that the books also comes with a course and also access to even more technologies, which is thanks to the fact that you purchase the book, you get access to that. So again, we are very, very much in our company in Trade with UFOs, which I founded. We are very much into not only building technology, but also creating tools that you guys can buy that support you on how to use the tools. Because we may have the best tools in the world, but if we don't support you on how to use it, if we don't support you on how to learn to use it, so then we are not doing a good favor to you. And maybe the book is a good place where to start, because the book comes with a course as well as the tools. Anyway, tradewithufos.com is our website. If you never attended a session with me, you may be wondering, what are UFOs? Well, UFOs mean on-field orders on the chart. They look like flying saucers, green or red. Green UFOs means sell on field orders. So when the market comes to the red, you would expect it to fall from there. So those are shorting opportunities. When price goes to the green UFO, buy on field orders are going to kick in. So you would expect the market to go up. So those buy on field orders are opportunities to buy. And they can be used for entries and exits as well. So targets, stops, and all of the above. Anyway, so you'll see me use that later on. But let's begin with the headlines. Okay, so again, very pragmatic approach. I'm not going to surprise you if I talk about Russia, Ukraine, and US-China tensions. At the same time, I don't have anything new to add to those news, which are not new. But the reason why I'm mentioning those news is because this is kind of like, a person who, may have the tendency to get, inflammation in the stomach, but you cannot help it. But you love to eat spicy, right? And many times you eat spicy and it's okay, but there is one day where you eat spicy and it's not okay at all, right? And it's because you have this tendency to, get your stomach to get inflamed with chili, right? So again, not an expert in the gastrodigestive system, okay, but you get my analogy, isn't it? So Russia, Ukraine, US, China tensions is something that is there. It's chronic. It's always there behind the scenes, and it takes something to happen in Europe, in the US, in China. It takes nothing to, next thing you know, it creates a cascade effect in the marketplace. So in other words, while I don't have anything specific to report about these particular tensions today, this is something for you to keep in the back of your mind all the time. And watch for it, because these are sources of opportunities as well as sources of risk. So this is something to keep in mind. The US fighting inflation is also nothing new. The one thing that is actually new from yesterday, is the fact that in the last hike of interest rates in the US, they went from rising it in a pretty powerful manner to raise only 0.25%. So in other words, the Fed is now realizing the consequences of what they have been doing, which is, they have been reducing the inflation rate a little bit. I mean, if you look at some of the past reports, there is a slight improvement. Not all reports, but only a few, but there is a slight improvement, I would say, as an average. They are doing their job, but at the same time, they are creating other issues, such as the failure of Silicon Valley Bank, SVB, or other banks that are now in problems. Why? Because if you raise the interest rates, you may have the inflation, but because you slow down consumption, but also what happens is that people get to pay more money for the same loans they have, and they may end up not being able to pay them, and then who suffers that? It's the banks. So again, this is like any system which is in balance. If you act on the right or the left or the middle or above or under, wherever you act, you're gonna generate some sort of an imbalance, and no one knows what's gonna happen. And certainly, while the Fed is, has extremely smart people and extremely powerful simulation systems and all sorts of tools that they use to have their decisions taken, the reality is that no one can predict the future, not even the Fed, and the consequences when it comes to their actions are to be seen in the marketplace. So again, whenever you see anything being reported about the financial industry in the past, few weeks, certainly open your eyes, listen carefully, because it may be a recipe of risk or opportunity in the marketplace. And certainly when the Fed is acting on inflation, or inflation numbers are being reported, or interest rates are being reported, certainly you gotta pay attention to that. You cannot ignore it, because it could be a source of opportunity or risk if you have trades running already. So keep that in mind. There is nothing that special today to be reported in that sense, but the fact that the interest rates were only risen by 0.25 yesterday, which was expected, to be honest, but it's a difference compared to what they were doing in the prior months. Earnings report, not too interesting today. While we got 409 reports today, the majority are very small caps, nothing that relevant. The only couple names I kind of thought of mentioning today is General Mills, which the ticker symbol is GIS, and ACN for Accenture. I would say those are probably the most relevant reports for today. Not that relevant either, but that's what I got for you guys when it comes to what I feel it's the most important information for earnings. Of course, no need to say that. Let's say you have a trade with some company which is not too relevant, but you have a trade running and they are reporting earnings today. Of course, pay attention to that, right? And maybe you want to get out before the earnings and things of that sort. Cool. So let's get into looking for real-time markets and look for market opportunities. I got a trade today ready for you guys with a stock called Salesforce.com. The ticker symbol is CRM. And what I'm going to do now is move away from the slides and jump into the real-time charts so we can do our planning and we can prepare a trade for you guys. So you can use that as an education opportunity. You can use that for practice purposes, etc., etc. This is not financial advice. I mean, that was stated already at the beginning of the session with the financial disclaimer. I requested everyone to read completely, so it was clearly stated. I want to state again one more time, the reason why I'm bringing in trade opportunities to the screen is because those opportunities are opportunities to practice. Again, taking the trades with real money, paper money, real size, big size, small size, all of those are indeed your decisions, and I have nothing to say there. So make sure from that educational angle that you pay great attention. And if you have questions, to be shy and make sure that you are asking such questions so I can help you when you are in the process of finding your own trades and building your spreads and all of those things that you do. So this is the time for you to ask questions so you can get your answers, okay? By the way, so far, you have been extremely shy on the chat box, which is not ideal for me from a presenting point of view, because I feel I am doing this by myself. So it would be great and nice of you guys to interact with me and engage a little bit, but also not ideal because you guys are actually missing an opportunity to learn more. So no need to be shy here. We are here to learn. I myself was a student of trading many years ago. And I do remember what is it to have this need to ask a question, but then feel my question is way too basic. I don't dare to ask. People are I'm gonna be slowing down the group. Well, no, this is not the case today. Today we are actually running this session to support you. So there is no need. There is authentically no need for you to be shy. And I would certainly welcome very, very much your questions, okay? And no matter if they're basic or if they're advanced, of course, for sure, go for it. So in order to prepare the trades, I'm going to use one of those sticky notes. So I want to be able to document the trade. So I'm just going to minimize it now, but I'm going to be using the sticky note in a moment. And notice that what I have here is the ticker symbol CRM, which is the stock I mentioned before. This is the company Salesforce. You can see the company name is here. Okay, and we are going to do a little bit of market analysis. So the first thing I would like to add to the screen, here we go. I would like to add to the screen this tool, which is called DT Trend. By the way, the tool I am utilizing, I never mentioned this. You know, I always go straight for the trades, and maybe I should. The tool I'm utilizing is called the Tradictive Options Planner. The Tradictive, T for Tradictive, O for Options, P for Planner. So this is what we call our top platform. It's a platform which is designed to plan options trades automatically for you. So, for example, if you think CRM is going to 214, so you can just right-click, send to the strategy builder, and automatically it will build the spreads for you. And the moment the spreads are built, you come in here and you're like, okay, I want to risk $250 per trade maximum. What can I do with that? You update, and now it's going to tell you this is the trades that you can take. And then you can sort based on return on investment. And then you will now know that your trade for today, if that was the case, is a bull call spread made of using the MEX version, 200 call and 195. And that way, you know, it doesn't matter if you're an expert with options or you're not at all. Now you can plan options trades which are automatically optimized for you at the speed of the light. And this, I guess, you see and you understand. We all see, we all understand is quite powerful. Okay, so this is top. And the way you would use it with Tiger Brokers is, you know, you do your planning with top. I mean, you can certainly visit our website to find out more about subscriptions and all of this to get access to the software. And then you can plan your trades, do your analysis, plan the trades, and then go execute such trades with Tiger Broker. Okay, so you can use us as a tools for analytic and research and market identification of opportunities, and then you can execute using Tiger Brokers, because our company Tradictive, we are not a broker, we are a trading technology provider. Okay, cool. Clarky, is a good time, all right, to buy S&P now? I'm going to talk about that SHD in just a moment. As I complete my analysis of CRM, then I'm going to do the SMARTT market analysis, and that I'm going to do it on the S&P. So bear with me, please, for a moment, and I'm getting there to answer your question. This tool is not free of use. Also, your second question there, thank you for interacting with me, SHD. So the way you can find out more about our tool, you can go to our website, which, if you recall, is tradewithufos.com. Okay, so you go there, you can take a look in the app section, and you will be able to see this tool. Okay, I said, and by the way, I forgot, so let me rewind a moment. I said I have a tool for you which is free, which is this one. This is Auto Climate. Okay, that one has a cost on our website, but with the coupon CLAIM8, then it becomes free, and this is thanks to being a Tiger Broker client. So you can use this direct link, which is also on our website, tradewithufos.com, and that will give you access to this tool called Auto Climate, which basically is a tool that is designed to tell you if it's time to be a buyer or if it's time to be a seller based on statistics, not based on a gut feeling or based on a subjective drawing of the lines or things of that sort. This is not about subjectivity, it's about stats. So, which is certainly a very powerful way to think of, you know, having a reference in the market. So, Auto Climate is also here. I have it here on my screen as well. Okay, and I'm going to use Auto Climate in a moment with the S&P. So you will see how I use it, and then you can turn it on TradingView, and therefore use it for all the stocks and all the futures markets that you trade with Tiger, including options. You can then use it using TradingView, which could be connected to Tiger Brokers. Okay, so I'll come back to this in a moment. Hopefully you guys had time to take a screenshot, you know, and grab that QR code, and also grab this coupon code CLAIM8, so that becomes free. Okay, Top, it's a full-blown professional grade trading platform, and obviously Top it's chargeable. It's not a free software. But again, you can look at it and you can find more information on the site, and certainly feel free to email me if you have questions. Anyway, so coming back to what I was doing, I'm sorry for going back and forth. It's all related in the end, so I hope you don't mind. But basically what I'm doing here is I'm looking at something called trend, which is looking at what is the strength of this particular market. And you can see we see blue, which means it's a market which is in an uptrend. But also, not only that, if I was, instead of looking at CRM, I was to look at the group in which CRM lives, which is software, programming, and medium. So this is extremely important, maybe even more important than what CRM is doing, which is the fact that the group all those stocks that belong to the same niche, they are also showing strength altogether. And that's very important, because if CRM was to try to go down, by itself, it may not be able to come back up. But even if CRM tries to go down in a very problematic manner, if the group ends up pushing back up, then CRM, even though maybe there is something wrong with the company, but because the whole industry as a whole is pushing up, the stock will tend to go back higher. It's a little bit of the same effect as the S&P. When the S&P goes up, most of the stocks tend to go up. When the S&P goes down, most of the stocks tend to go down. In this case, I'm fine-tuning it to the group, which is software, programming, and medium, and the sector, which is technology, which is also going up. So we got the sector going up, we got the grouping, which is software, going up, and we got the stock going up. Okay, so we have a market condition. Trends tend to last. They don't last forever, but statistically speaking, they tend to last. So we have a market setup where we have something that tends to be lasting, the trend, for the stock, for the group, and for the industry as a whole. So that is certainly a good thing to have behind the scenes in your favor before you buy a security such as a stock, because stocks, compared to the whole market, you got 9,000 stocks in the US, rounding numbers. One stock, no matter how big it is, it's quite small compared to the size of the whole market. So having the backing of the industry behind the stock is certainly going to lead, more often than not, to desirable results. Okay. Now, another thing I like very much is the fact that the next UFO, remember UFO on field orders to sell? So that one is very far up. Why do I like that very much? Well, because this opens up room for profit. So look at that. If I was to look at Microsoft, for example, which is also a company, if I go back to the trend, right? If I look at the trend for Microsoft, it's also blue. If I look at the group, okay, it's a different group, right? So it's not software. Well, actually, yes, it's the same group. What am I saying? Software, programming, and medium is also up. And obviously, it's also technology. So the sector is also up. So I got the same three components. The stock is going up, the industry is going up, the niche is going up, the whole thing is going up. That's great. But notice that the moment Microsoft starts going higher, I'm not saying that is a wrong thing to buy Microsoft. So it's going to hit that red UFO. And from there, more often than not, it's going to go back down. Because on-field orders will kick in, sell on-field orders will kick in, and that's going to tend to bring the stock down, or at least to slow it down for a while, and it's going like that, like that, like that, like that, like that, and maybe finally it breaks up, but you are losing a lot of efficiency on performance because that red UFO happens to be there relatively near to the current price. Where if I look at CRM, the reason why I like this setup, okay, WX8989. I'm guessing that you are enjoying the presentation with your wow. Thank you for that. So when you look at CRM, the difference is that not only now CRM is on a green UFO, and therefore from there is likely going to bounce up. Okay, so it's perfect timing. On top of that, if it does go up, the next red UFO is further up, further away, which opens what we call profit margin from the current price all the way to 214, right? Which could be a very valid target on where to take the trade. Okay, so that is why I'm pointing at CRM today. I mean, there are other opportunities in the market, but certainly those are opportunities that I would, qualify of, a little bit of a higher quality, and therefore we have a little bit better statistical edge in our favor to perform these trades. Now, having said that, look at, and I'll do my S&P analysis properly in a moment, but look at the move yesterday on the S&P going down like crazy, with an Elliott wave turning point being identified on the way down for the S&P, with an Elliott wave target of 380. So the market may fall before then it goes back up. Okay, I mean, I'll do a better analysis in a moment. Okay? I will do a much better analysis in a moment. But my point right now is that while we have a good candidate to buy as CRM, there is a certain degree of risk given what the market is doing right now, which is not totally defined. and certainly we could have a powerful leg on the way down, happening. Okay, given what I just said. So I am bullish CRM, but I am a little bit on a skeptical mode, because while the grouping is in my favor, the industry is in my favor, the stock has a good setup, the S&P is showing a little bit of potential risk. So therefore, as a trader, I'm thinking, oh, I need to add myself some sort of tool or mechanics to avoid trouble in case I'm wrong and the stock goes against me, given the condition that we have on the S&P. And what can I do here? Well, one approach would be the following. Okay, so one approach would be, and maybe I'm going to do some drawing on the screen. So one approach would be to come here to 65. Okay, we got 64.77, which is the next UFO. Okay, so in other words, if the S&P proves me wrong and the market goes down, because the S&P is going down all the way to 380, which is the Elliott wave target. So then CRM may come to 165, and now buy on fillers kick in, and now the probability of going higher is even higher than the probability of going higher from today, right? So in other words, I'm looking at 165 as a very, very valid price point. Okay, very, very valid price point. I can even, talking about using options data, I can even add a volume map, which is another tool that we have on the platform, which is patented. And when we look at the volume map, if I was to add more strikes, this is options data, okay? This is options data. So if I look at strikes above and below, let's do 10. I believe this should be enough. Yes. So if I look at 10 strikes above and below, okay, and instead of looking at volume, I look at open interest. Okay, yeah, I should have prepared that before. Sorry about that. Bear with me one moment. I need to change one setting here. So instead of looking at the weeklies, yeah, I'm just gonna focus on the monthlies. So I'm just gonna look at the most relevant expiration dates. And when I do that, okay, I got a few here. So you can see how we got significant open interest at 180. So that's going to act as a very strong support. So if CRM goes down beyond this UFO, which should not, when it goes below, we're going to find a UFO on the options, if you wish, which is this, okay? And certainly if it goes to 165 too, you can see here that this is much more than this or this. So we got multiple, let's call it mini supports below price. The strongest being 180. So the probability of getting to 165 is relatively low. But certainly if we get to 165 is indeed confirmed as a very relevant number. On top of that, we have a UFO on the screen. So both from the options angle as well as from the technical angle by looking at the chart, so 165 is very relevant. So what can I do? Well, one approach could be to go ahead and sell. Minus sign is for sell. I could sell the 165 put, okay? And if that stock falls to 165, then, of course, it would show a negative P&L on your account at this moment in time. But if you wait and the stock is put to you, now you would own CRM at 165, which is currently trading at 186. So it's like $20 lower than price. So it's like, let's call it 10% cheaper. So you get the stock delivered to you at a much better price. Like, I'm just doing very bad math here, rounding numbers, 10% cheaper, right? So it's nice. If you want to hold shares of CRM, you can get them at 10% discount. That's okay. Knowing that if CRM goes up or goes down a bit and then goes up, or goes nowhere and stays like that all the way to the expiration date, no matter what, the credit collected by selling the 165 remains as yours. Right? So that is certainly something that is in line with the little bit skeptical approach I mentioned when I looked at the S&P, and I can see there is room for the S&P to fall. Well, if the S&P falls and therefore CRM falls all the way to 165, while I would temporarily see a negative P&L on my account, actually I don't, because the moment the stock is put to me, it's put at 165 and the credit collected stays as mine. I want to give you actually a better alternative than that, but I wanted to start my explanation by pointing at this, which is, let's say I'm going to use May expiration, and I'm going to look at one strike. The one I want is the 165. So the 165 strike, it's the put, which is here on the right side of my screen. Okay, the puts are trading at 243. So if I bring a calculator and we do some math, one moment. Here we go. I'll be zooming in a moment, okay? Thanks for your comments, Sab and Nutia Gona. I will be zooming in a moment, no worries. Thank you for letting me that it looks small on the screen. So I said 243, right? Yes. So 243 is the amount of premium you would collect if you sell the put. Now, this put will expire in 57 days, as you can see here. That's May 19 expiration. So in other words, how much money is that? Well, if I sell the 240, if I sell a put which pays me 243, in exchange for my intention to acquire the stock at 165, and this is for 57 days, and I want to annualize my return on investment, so I multiply times 365. So this is 9.4% return in a year. Okay, so this trade is an equivalent 10% per year, okay, that you would collect if the stock, instead of coming to you, the stock does whatever, stays there, or goes up, or goes down, or does whatever. As long as the stock stays above 165, no matter what it did, you made 10% annualized rate of return. But now if the stock falls, it gets to, let's call it the perfect buying price point. I mean, perfect based on my methods, on UFO methods, and there is nothing perfect because we don't know the future. But statistically speaking, I dare to say perfect, if you know what I mean, because it's my method. So you would now get the stock delivered to you at your preferred price. And now from there, odds are the stock is going to move your way. And, even if it only moves from 165 to 175, you made a lot of money, plus you also made your 10%. And on top of that, you reduce the risk because, I think I closed the calculator. Let me reopen the calculator. Sorry about that. Yes, because you got the stock put to you at 243 at 165, but you got paid $2.43 to get the stock put to you, so your net entry price is actually 162. So while the stock is given to you at 165, you keep the premium, which creates a net entry cost of 162, which is somewhere there in the middle of the UFO. Actually, quite ideal because the inner circle inside the UFO represents where the greatest quantity of on-field orders are. That's what this represents. So anyway, so that's the trade setup. Now, having said that, I want to give you one variation, which is my preferred choice, which is instead of selling the 165 put, instead, something I prefer to do is buy a put above. Okay, let me show you the option chain. Again, we are looking at May. We are looking at the 165, and the one above is 160. So 165 and 170. So 165 and 170. Okay, so let me zoom in now. So you got 165 and 170. Okay, now what if I buy the 170, and instead of selling one of the 165, what if I sell two? Okay, what if I sell two? Well, take a look. If let me compress this so I can have all the information on the screen for you guys in case you are taking screenshots or something. So what I could do is I could do this. I could buy the 170 put, and then below sell two of the 165 put. If I do that, what happens? Well, I will need to pay 374, but I will get to receive 2 times 243. So 2 times 243 is more than 1 time 374. So I will end up with a credit. Lesser than before, but I will end up with a credit. Let me document this. So CRM. CRM, earnings for CRM. That is on May 30. May 13, 2023. So what if I use the May 19 expiration? Okay, and what I do is I focus on selling the 165 put, okay, but instead I buy the 170 and sell 2 of the 165. So instead of only selling the 165, what if I buy the 170 and I sell 2 of the 165? So what would be the premium collected in such case? Would be less. Okay, would be less because now I would pay 374, and I would collect, sorry guys, 374, and I would collect 2 times 243, which gives me a net credit of 112. Okay, so I will get a net credit of 112, instead of a credit of 243. So my second plan here in the bottom part receives less credit. So you make less. So why do I do it? Well, because if the market goes against you and gets to 165, right? So what's going to happen? Well, you're going to get put. Did I just close the calculator again? What's happening? I just click closing the calculator. Sorry about that. So you're gonna get the stock put to you at 165 twice. Okay. So you will be liable. Let me open the sticky notes so you can compare the information. So you will get the stock put to you twice because it's times 2. So you got 200 shares instead of 100 shares. But actually, you will also sell 100 shares of your 200 shares would be sold at 170. So in other words, if I buy shares at 165 and I sell shares at 170, actually I made a profit of 5. Right? So I made a profit of 5 in order to get put 100 shares at 165, which reduces my net cost basis to 160. And on top of that, I am also making $1.12 on that, reducing my entry price to $1.12 to 158.88, which is even lesser. So notice that if you only sell the 165 put by itself, I said before that your net entry cost is 162 something, where if you do the below combination, and you get the stock put to you, you get put 200 shares, but 100 shares are sold at 170. So you are still net owning 100 shares, but now your break-even price is 158, which, it's even below the UFO. So you're buying at a price which is ridiculously cheap, given what we have on the screen, making this trade certainly an intelligent approach, even though, of course, there is nothing guaranteed in trading. And this is just a trade example. For you to think about, for you to learn about options, and hopefully that was useful to you. So I'm done with the explanation here for this trade. I'm going to look at your questions because I see a few. Clarify your questions, and then we'll do the market analysis, and then we will call it the day. I got Kubera. It's buy put or sell put. So the simpler application is sell. The minus sign is for sell. Sell one of the 165 put. That is a simple explanation that will bring in $243 of credit, and that's it, end of the story. Now, the more advanced approach, which will bring in less credit, that's the downside, but while it will bring in less credit, if the stock does fall all the way to 165, then you had purchased plus sign buy one of the 170 put, and you have sold minus sign 2, important that you realize there are 2 of the 165 put. So you do double the trade from above, and you buy the 170 call, 170 put, sorry about that. That will reduce the net credit, but when the stock is being put to you, you're going to make the difference between 165 and 170, which is $5, and that therefore will diminish your net entry price by that amount, which is way more than 243. That's why if you were to do this, your break-even point now, and I just noticed I just closed the calculator again. Sorry about that. Not sure what's going on today with me and the calculator. But anyway, you get my point. Hopefully this answers your question, that the second approach is more complex. It has more options, contracts, and all of the above, but it has a great advantage in case you really want the stock put to you. You're going to get it put to you with a break-even point of 158.8 instead of a break-even point of 152 plus. Anyway, what happens if you close the put the put before? Well, to close the put before SAP, you will not sell the put. You would buy the put back. Remember, you start the trade by selling the put. So I know what you mean, but at the same time, I want to avoid the confusion. To close the put, you don't sell. You sold to open. So you buy to close. Okay, the right action is buy to close. Okay, and obviously you can do it anytime before expiration. That's not a problem at all. The only impact is what has the stock done during the life of the trade. So if you sell the put today, and as predicted, the stock goes up, and you sell it on that date, you're going to make a profit because you're going to be able to buy back the put at a lesser price. Why? Because when the stocks go up, the puts go down. So you could do it. Now, of course, if the stock was to go down and you want to buy the put to close here, you're going to buy, you can do it, but you would do that for a loss. That to me would make no sense, because the whole premise, the whole market setup that we are defining here is that you want the stock put to you on 165. That's why you are doing this. If you don't want the stock put to you 165, then don't do this trade. What you do then is, if you just want to speculate on direction and you don't want delivery of stock, then you just build a spread. Okay, and the spread, would be built like that. You look at your target, and for example, following up with what I did before, if you wanted to risk, let's say, $200 per trade, so the spread that you may want to consider doing is that bull call spread here, by buying the 195 call and selling the 200 call. Okay, but that's a different story. That's not what I was doing today. I'm highlighting this on the screen to clarify the various different ways on how to use options, given your question. So that's great that you asked, you give me that opportunity. But yeah, it's a totally different approach. Okay, when you do a bull call spread, you will never take delivery of the stock. When you sell a put, this is what is technically known as a cash secured put, and you do it, it's cash secured because you're using the same amount of money you need to buy the stock to sell the put, which means you are planning for stock delivery. If you are not planning for stock delivery, I would strongly suggest not to do this trade, because that's not what this trade is for. Is that making sense? It's like driving a Ferrari car in the mountain road. The Ferrari car is not designed for the mountain road. If you want to be speculative and directional, then you would use option spreads. This is an investment method on how to get stocks delivered to you at a lower price, and I gave you two ways on how to do it. One very simple, by just selling a put. One more advanced, which I prefer, which is using a put that you buy and selling two puts against. Okay. Great. Hopefully this helps to clarify. Thank you so much, guys. I love it that you guys are interacting with me, because again, it makes it so much more fun on my end. Plus, I do believe that this is now providing so much more value for you guys, isn't it? Because now, if you want to do that, if you don't want to do that, if it's useful to you, if it's not useful to you, if you want to look for opportunities like that and how to build them, or you don't. So thank you for interacting with me. Anyway, I'm looking at the clock. We're supposed to conclude this in 2 minutes. So let's do our S&P analysis at the speed of the light. Before we do it, I want one more time, in case you came late, to flash the QR code on how you can get AutoClimate, because you are about to see me use AutoClimate. So take a screenshot if you haven't yet. I'll take a sip of water and we go for the S&P. Okay, so S&P. So to analyze the S&P, I'm going to use a few charts. The first thing I have on the left is the SPY ETF on a daily time frame. That's the first thing I'm using on the left. And on the right, I am using the S&P futures using an intraday time frame, which is 34 minutes. Okay, so looking at the intraday futures data and looking at the daily ETF data. Okay, it's all S&P, but it's different products, even though it's the same word. Okay, so what can we see? Well, the first thing that we can see is that the futures are up 0.41%. That's what we can see. So when the market opens in 45 minutes time, we should see a gap up on the S&P. So probably this daily candle that closed here yesterday, probably we have a blue candle that starts trading somewhere around here. Okay, and from there, the market may go up, the market may go down. We'll talk about this in a moment, but that's going to be more or less the starting time, the starting price for the session for today, given what we see happening on the futures. Now, since I'm talking about the futures, let's talk about something very relevant, which is the fact that we have a red UFO right here. Okay, we have a red UFO right here, and you can see what happens when price go to the UFOs. They bounce. Okay, they bounce from those UFOs. So you can see that, you know, if the S&P futures keeps going higher, okay, probably later in the day it's going to come back down. And then, of course, there's a UFO, so then it may go back up. But so I would expect for today's trading session to have a market a little bit range bound. This is what I would expect. So I would not be surprised if tomorrow, given the location of those UFOs, when the market has closed, if you were to look at the chart, the daily candlestick look something like that. I will not be surprised. Okay, why? Because that's where the UFOs are on the intraday time frame, on the futures, but also on the ETF. So notice on the ETF, if the ETF goes down, there is green, right? And it will tend to go back up. And this green UFO at 388, right? If we compare with the S&P futures, so 388, you know, it's that green UFO. Okay, 389, 388. There is a little bit of a difference in prices between the futures and the ETFs, but basically notice how both on the futures markets as well as on the equity markets, we have buy on fillers at this price. So if the market goes down, I can totally see the market going back up. But again, before it needs to clear that one. So that's probably something to happen tomorrow, but not today. And then we got another UFO here at 4,000 plus. Okay, so if I look at the ETF, you know, 404 is that red UFO. So in other words, the equity UFOs and the future UFOs are lining up perfectly, which is going to make those UFOs to be very strong. So if the S&P goes here, it's going to tend to go down. If it goes down, it's going to tend to go up. So I would envision the market to be range bound, maybe for a couple of days, definitely for one day at least today. That's what I would envision as the market opens, given this market data. But most importantly, when it comes to multiple day duration trades, when it comes to what's happening in the market overall, so I am again relying on the daily time frame here on the left, and now I am relying on auto climate. And guess what we have with the auto climate? So we have a blue climate. But notice that we have two components here. So first, notice how this dot is thin. Notice how those dots were thick. Okay, but that dot was thin. So just like the dot we have today, or that dot there. So thin means what? Thin means not confirmed. The climate in the market is not confirmed. And look, notice what tends to happen when the market is not confirmed. When it's not confirmed, it changes from color, from blue to red, you know, not confirmed, red to blue, no confirmed, red to blue. You know, now when it confirms, now you have a higher probability of consistency on the directional move. The market's falling because it was red. Or here, you know, the market is going up because it was blue, right? During that period. But the key is that the dot is thick instead of thin. So today, notice that the dot is thin. So why would I expect? Well, I would expect a change of color. As the market opens, we're going to have red. Okay, and the market will have a greater tendency to go down than up, because again, auto climate is calculated based on statistics. So based on statistics, the market is likely going to move down more than moving up, even though for one day, range bound, given the UFOs. Now, having said that, what do I expect after one day? I expect the markets to go back up. Okay, and this is why I was daring to present the trade on CRM, because based on my methodologies on how I trade and the tools I use, auto climate or auto UFOs, the market is going to go back up to me based on that data because, and notice what's happening here. We can see here the implied volatility comparison for the calls in blue color. Okay, so this is calls. And for the puts in gray color. And notice that the blue line is above the gray. That was not the case a few days ago. Since that day, the gray line was about the blue. And what happened next? It went to become heavy red. What did just happen a few days ago? The blue line went above the gray, and it's starting to show some blue, even though we're going to see some red today. But I am pretty confident about this blue line being above the gray line. And when I say confident, I mean confident on the methodology. I cannot predict the future either. I just trade based on probabilities. But I am definitely, quite comfortable with the setup because when the blue line is above the gray line, it means that either, let me write it down, more calls are bought than puts, or more puts are sold than calls. That's what this means. And when there are more calls purchased than puts, that, my friends, is bullish. And when there are more puts sold than calls, that, my friends, is bullish. So in other words, when the blue line is above the gray, what I can tell you is that on the options markets, and you may recall the volume map I showed you before, on the options markets, our technology is identifying buyers. There are buyers in the markets, and that's why the blue line is above the gray. Now, in the options markets, there are many strikes. So the buyers are spread across strikes. Okay, so this is the blue line above the gray doesn't tell you buy now. It tells you there are buyers in the market. So we have a market condition that will tend through time to go higher, unless we have a change and the gray line goes above the blue, like it did happen some days ago when the SVB scandal was made public, and many sellers panicked and came into the markets, and we saw that in the options markets. And look at what happened next, right? Nice, powerful moves on the downside. So now we got the opposite. We got buyers in the market. So even if the market falls a bit, 1%, 2%, whatever, in the following days, doesn't matter to me, because we see buyers in the market, and therefore ultimately the climate will turn back to be blue. Notice that even though is now blue, it's not confirmed. And the reason why it's not confirmed is because, notice the contradiction. We got buyers in the market, but yesterday the move to the downside was quite powerful, which means that the buyers are slightly lower. And by the way, slightly lower is where we placed our puts for the CRM trade. So again, we are quite aligned with the S&P and the sector and the industry and the stock. And that was all for me for today. When it comes to explaining to you guys how I read the markets with the tools I use, and hopefully that made sense. I'm going to take one last look to the chat box. I can see some questions there. Actually, one last question I can see here. Will this live stream be made? Yes, I mean, we are streaming live at this moment in time, and the recording is also going to be posted both on YouTube as well as on the Tiger Broker app. So the answer to your question is yes. And by the way, I am live twice per month on certain Mondays and certain Thursdays. So keep an eye on the schedule, keep an eye on the app, and feel free to join me, and feel free to interact with me, guys. This has been a lot of fun today, guys. Thank you so much for your participation, and hopefully I did open your eyes to certain things that I do that you could be doing, and this was useful to you guys. Feel free to prepare your questions for next session. Happy to do a little bit of coaching time. If you have specific questions that you want to ask, maybe you went to practice this during the whole 1 or 2 weeks until we meet again. And then when we meet, you have questions about it, happy to be a little bit of your coach in these sessions. If you need me to adopt that role, happy to help. You guys take care. See you soon. Tiger Brokers, thank you very much as well for organizing this. And I'm going to flash one last time the QR code with a coupon code for you to get your auto climate for free. Obviously, understanding the climate in the market is critical, because there are times where you don't want to be a buyer, and there are times where you don't want to be a seller. And thanks to the climate, so it's pretty clear what is more advantageous statistically speaking. Okay, my friends, take care, everyone. Thanks for joining me. See you on the next one. Bye bye, everybody.